here on our Minorum YouTube channel again, and we're here at the Sprott Natural Resource Symposium here in Vancouver, and I'm again joined by Jordan Roy-Byrne of the Daily Gold, one of the best technical analysts out there. Thanks a lot for being on the show.
Thanks so much for having me, Sonny. It's my pleasure to be here.
That's great. Thanks, Jordan. So, I wanted to kind of review the presentation you actually gave at the Metals Investor Forum a couple months ago, which is a really excellent presentation. You had a lot of charts on there and a lot of historical references, which kind of puts the sector in perspective and the precious metals prices as well. So let's start off with interest rates. That's been the talk for the last year and a bit now, and I just want to talk about why are real interest rates the real driver for gold, or are there any other outlier events or items that you look at?
Well, in my opinion, from reviewing historical data and real interest rates and how gold performs amid rising and falling real interest rates, it's very clear to me that real interest rates are the real driver for gold, and specifically negative real rates or falling real interest rates are what drive gold in bull markets. And actually, if we look at, let's go back to 2011. From 2011 to 2015, the awful bear market that the sector was in, real interest rates actually increased. Now they went, depending on what you look at, you can look at the real Fed funds rate, you can look at the 5-year yield, even the 10-year yield. People use different metrics to measure it, but when looking at those things, real interest rates actually went up during that period. They went from -3 or -4% to 0, maybe a little positive. So even though real interest rates were not strongly positive, they were still going up. And so that was negative for the sector. And actually in about the middle of 2015, I think, that's when real interest rates peaked. And they've been going down since that point. I mean, they're slightly negative now, but that trend of real interest rates rising ended in 2015. They're moving in the other direction. So that's the fundamental underpinning of the bull market that we're in right now, the cyclical bull market, but also in the big picture, in the secular bull market. I mean, not to go on and on, but if you look at the early 80s, some people, they say, well, how do we know this is not 1982, when there was a very sharp bounce in gold in 1982, and then the bear market continued after that? Well, there's many reasons, but the biggest fundamental reason is if you look at real interest rates in the early 80s, I mean, they were 5, 6, 7% positive. So there was no, and I know we're getting into the other question, but there was no incentive for people to own gold. If you can put your money in the bank and earn 5, 6%, if inflation's only 1, 2%, you're earning a real rate of return, an inflation-adjusted positive rate of return on your money. And when you can't earn anything on your money, if inflation is 2, 3% and rates are only 0, 1%, you actually lose money if you put it in the bank or put it in one of these instruments. You're not earning a real rate of return on your money, and that's why gold does very well in that environment, because it's in basically a low-yielding environment. Gold does really well because there's no competition for it, like I just explained with respect to putting your money in the bank or putting it in these short-term instruments.
No, absolutely. So explain, I guess, to what does it mean to the individual investor or the saver in terms of negative yields? Because you're seeing that a lot of in terms of the bond situation. I mean, there's negative yields in terms of debt. So can you explain that? What does that really mean to the individual investor when they have money in the bank?
Well, it means that they have to basically speculate to earn a yield. They have to speculate on other assets, and we're seeing that where the stock market and some blue chip companies, they're basically acting as bonds almost, because if you can get a 2 or 3% yield by buying blue chip safe companies, as they say, I mean, just look at the utility stocks, which are people who want to get yield, want to get dividends. They own utility stocks. I mean, the valuations on those are extremely high by historical standards, and that's because people who want to earn a return 2, 3, 4, 5%, they can't get that in bonds or these safer instruments, so they're therefore speculating on safe stocks, and by the same token, gold is also a speculation. I mean, that's a whole other conversation, but it is a speculation, and it is an option if you can't earn a real rate of return on bonds or your money in the bank.
So then let's step over now to And you did go into the discussion of inflation and interest rates. So you mentioned in that presentation staying behind the curve. So can you just explain the mechanics of that and what you mean by that?
Well, when people talk about the Fed being behind the curve, that means they're not raising rates fast enough to combat inflation. And so when they're staying behind the curve, like let's say inflation starts to go up
Right.
to 2-3% in the Fed.
Which is what the Fed has been waiting for.
Yes, they want that to happen. They want that to happen, but not because they're going to raise rates, but that needs to happen to devalue all the debt in real terms. I mean, if you look back, which I talked about in my book, if you look back in the 1940s, I mean, that was a crazy period where they had to let inflation run, and it was very volatile. I mean, there was a year where it was 19%, and then the next year it was 2%, and then it was 0 the next year, then it was 13%. They had to let inflation run because that's what devalues the debt, which is basically preventing it's caused this global slowdown, especially in the Western world, where we basically can't grow.
Right.
And to get out of the debt burden, you need growth and inflation, and we're not getting either of that.
Right.
So the Fed will stay behind the curve when inflation picks up, whether it's a year or 5 years or whenever. But when that starts to rise, the Fed will just raise rates in baby steps and stay behind the curve.
Right.
They're not going to, to give you an example, let's say inflation went up to 5% and rates were at 1%. Now, in a normal economy where we don't have this debt problem, they would probably raise rates to 7%.
Right.
But if they're below 5%, they only, people say, oh, well, they're going to raise rates, that's bad for gold. Well, if inflation is 5% and, interest rates, shorter term yields are 1%, and they only raise the Fed funds rate to 2 or 3%, it's still way behind that 5% inflation.
Right, yeah.
They're behind the curve.
Always, okay.
So they're behind the curve, basically they're not combating inflation, and behind the curve also means that it also, I should say, if they're behind the curve, that means negative real interest rates will persist.
So I also wanted to bring up a chart that you actually had mentioned in your presentation. It's very interesting. It's called the analog curve, and you bring up a few historical periods that are showing the trends, and one of them was mirroring the 2008 timeline to what we're experiencing right now. And it's very interesting, but I'll let you explain it so our readers can understand on the chart there.
Well, the first thing I should mention is these analog curves come from my own proprietary junior gold index, which has changed over time.
Right.
But right now, the median market capitalization is about 400 million US. It was lower months ago, obviously, when prices were lower. There's some just very small companies in it, some that have grown larger. But essentially, we have three curves on this chart, and the two ones in the past come from the 2001 bottom in the sector and the October 2008 bottom in the sector. And so we're comparing the bottom that we had this year, January 2016, we are comparing that to those other two periods.
Okay.
And it's very interesting because if you look at, obviously the viewers can see the chart, they can see how this current bull market is basically, it's right on top of the 2008 bull market. It's literally amazing how the last couple months it's been right on top of the same line.
Right.
And by the way, if you look at the TSX Venture, it's almost the exact same. It's the same thing. It's interesting to me because if you look at the macro situation, kind of the big picture economic situation, how markets are trading, in my opinion, we're a lot similar to that 2001 period. And if you just look at where gold stocks, the kind of bottom that they made in the early 2000s,
right.
It's much more similar to where we are now.
Right.
Which could be a real secular bottom.
Right.
Whereas 2008, that was not a secular bottom. It was more of a cyclical bottom, even though there was a crash into that. But I find that very interesting how we're mirroring that 2008 rise so closely. Yet the macro says this is more like 2001 than 2008, and I would just add, even though the 2008, that bull market only lasted about 2.5 years, maybe a little bit less than 3 years. Where we are now, given the history, given the things I talked about in my book, this is going to be, in my opinion, far more like the 2001, that bottom, which eventually ran up into 2006, 2007. So I'm expecting this cyclical move that we're in is not going to last 2.5 to 3 years like the last one from 2008. It should be more like the one we had starting in 2001.
Oh, one of the other things I want to mention as well, Jordan, is, what we haven't seen in a very long time is the fact that the US dollar is actually rising in contagion with the gold price. Does that seem, is that normal? Is that odd? What's your take on that?
Well, what we are seeing is that gold's fundamentals are so strong that it's even rising in US dollar terms, which itself is rising. Now, if you look at gold priced in foreign currencies, which most people do not do, I do that quite often. Sorry to pat myself on the back.
Why would you do that, though?
Well, because it tells you how is gold performing in real terms. I talk about this in my book. How is gold performing against the other currencies? How is gold performing against the S&P 500? How is gold performing against commodities? Looking at gold's performance against foreign currencies and all these asset classes, it really gives you an idea of the real performance of gold. In other words, is gold rising just because the dollar is going down, or is gold rising in real terms? Mm-hmm. And the fact that gold, it's been rising a little bit against the stock market this year, which is positive, but it's rising a lot more against foreign currencies. If you look at gold against the Australian dollar, it came back and retested its 2011 high.
Interesting.
You being in Canada, you know that the gold price in Canada is very close to that 2011 all-time high. Same thing with gold against the euro. If you look at, if you measure gold against basically the US dollar basket and those currencies, it recently was about 7 or 8% from an all-time high. So if we see gold go up to 1,400, 1,450, at that point I think we could see gold against the foreign currency index. It could be retesting the 2011 high. And what that, from a stock standpoint, that actually tells you that assets outside of the U.S., mining assets, will be more desirable. Places like Canada, Australia, because of the gold price there is so much stronger. So the costs that are denominated in the Canadian dollar, Australian dollar. There's some places in Africa where the euro is the currency. Those places against the U.S. have an advantage given the environment that we're in right now, where the gold price is rising and also the U.S. dollar is rising. Basically what that tells me, as I've already said, is the gold price against foreign currencies is so much stronger.
Right.
And so this is all positive. If U.S. dollar is rising and gold started to go down, it kept doing that for a year or so. Mm-hmm. That tells you that gold in real terms is very weak.
I think one thing that should be important that you should mention is your book. If you want to talk about a little bit about that and how people can get access to that.
Well, you can go to dailygold.com/book and you can get my book for free, and it contains all the important best research and analysis that I've done over the last couple of years, and I put that into a book. And I'm going to be doing an update on that in the next couple months. I wrote the book in 2015 talking about the coming renewal of the secular bull market. Right. Now that it has renewed, we have to look at things from the bullish perspective. Because in the book, the charts, there's bear analogs. Yes, worst bear markets in gold, worst bear markets in gold, stocks, silver. Now we need to turn it around and look at, okay, how does this run so far compared to the bull markets, which we've talked about for the stocks. We could talk. We'll talk about it in the book for the metals, I should say.
Right.
We don't have time for that. That would be a whole nother interview. But last comment I'll make is in a bull market, you basically buy and hold, and a lot of people got scared and they saw this huge move up, and you don't want to chase things, but at the same time, don't wait for some 40 or 50% correction. If you're eyeing some stocks and they correct 10, 15, 20%, you want to jump on that, because we're not going to see these stocks correct 40 or 50% anytime soon. When that happens, they'll be correcting from much higher levels than where they are now, and it's tough. Just look at any bull market. Most bull markets, you have to buy and hold, and that's how you'll make money. You're not going to waiting for some major correction. It's not going to happen anytime soon.
Absolutely. Okay, well, thanks a lot, Jordan, for your time. And if you want to find out more information, please visit his website at thedailygold.com, and you can see his book, and you can also get in direct contact with Jordan and ask him any questions and go from there. So thanks a lot, Jordan.
Thanks so much for having me, Sonny. Real pleasure.
Absolutely.